In this video, I want to look at a type of fund that's increasingly popular with some investors, the exchange-traded fund. Look at the pros, look at the cons, and look at three different styles. So, with no more ado, where do they fit into the picture? Well, there are actually, as I see it, four types of fund. In other videos, I deal with the open-ended style and the closed-ended style. In this one, I don't want to look at hedge funds. I just want to look at what are called ETFs. And I'm focusing on the equity market here, so I'm not going to look at the alternative, the ETC. I'm not really going to look at the ETN either, just the ETF, the Exchange Traded Fund. So with no more ado, how many types are there? Well, basically three. Now, what is an Exchange Traded Fund? It is the simplest of fund types, in theory, until you get to the more complicated ones. But a basic ETF does a very simple job. It is a share that's traded on an exchange, trades in the normal way that shares do, subject to a bid to offer spread and so on, and simply follows something else. Now that something else could very commonly be an index. The earliest ETFs were index-based. It could be a sector, banks for example. It could be a basket of shares constructed on a particular formula. But the bottom line is there's no active fund management, there's no active stock selection. It is simply something that follows the underlying, whatever that underlying happens to be. As a result, they're marketed as being simple, relatively low cost, because there's no active fund management, and the future of investing in some cases. That last bit I don't agree with. I think they're part of the future of investing. They're a useful part of any investor's portfolio, but like any investment tool, there are advantages and disadvantages to using them. So let's take a quick look at the pros and cons of the straightforward, old-fashioned tracker, the strategy-based or smart beta style briefly, and the more complex ones. And be very careful with the more complex ones because there you're quite a long way away from the original cheap, simple purpose of exchange-traded funds. Okay, so trackers do what they say on the tin, or should do. They are simple, cheap, and they follow an index sector or a defined basket of shares. What could possibly go wrong? Well, on the right-hand side, you will only ever get the performance of the market, and tracking error means you may not even get that. I'll try and illustrate why in a moment. Because in a lot of cases, they are market capitalization weighted. What do I mean by that? They're following the FTSE 100. And the FTSE 100, for example, as an index, is market capitalization driven. So the biggest firms by value go to the top of the index, and therefore an ETF that tracks the FTSE 100 will hold as a proportion of its own funds a substantial weighting towards those big companies. You're buying the biggest, most expensive companies in the market. So in other words, you're kind of buying high through some of these ETFs and almost selling low because they'll dump them when they're cheaper and smaller. And that's really, some would say, the opposite of what a good contrarian investor should be looking to do, buy low and sell high. So following the market, fine, but you'll only get the market's performance. You'll only get that with no tracking error. Now the point about under-diversification is this. People say, great, an ETF that follows the FTSE 100 will give me access to a broad range of shares. Well, maybe, but the FTSE 100 as an index, for example, is dominated by a handful of sectors and dominated by a few quite big stocks. You may not be as diversified as perhaps you think you are. Tracking error is the idea that a lot of ETFs that claim to follow an index actually don't, insofar as they only buy a certain proportion of the index constituents. And that leads to this sort of thing, where the underlying index might do that, but the ETF does that. So it deviates below or above the underlying index, and that's because it hasn't bought all of the constituents of the underlying index. So my point is, yes, the original simple, cheap ETFs have their place, but be aware they're not perfect, and you may be surprised sometimes by the manner in which they behave in relation to the underlying index they claim to follow. Okay, in a nutshell, what's a strategy-based ETF? Smart beta, as some of these are sometimes known. This is one that tries to replicate an investment approach. So it might say, it follows higher dividend paying stocks, for example. It's a dividend aristocrat style ETF. Or it has a mechanical computer-driven screening process that picks stocks on the basis of sales or cash flow or book value. In other words, it tries to mirror what a sort of contrarian active fund manager might try and do or might have tried to do in the past that was successful. For that reason, they're often called smart beta. And they claim to be the best of both worlds. Watch out for the marketing. They claim to give you the performance of active fund management for the price of passive. But is that really true? Well, they are more complex and therefore they are more expensive than simple ETFs. And frankly, the jury is out on the performance claims. I've yet to see a comprehensive study that proves that a back-tested strategy of screening stocks mechanically can beat the market and offer superior returns. All right? So just be careful. It's important to pick the right ones and understand the strategy and the way they've designed it. In other words, you need to look under the bonnet here. Just be careful because the marketing can be quite powerful. Then you hit the complex ones. Now this is taking ETFs a long way away from their origins, if you like. You've got the ones that are geared, derivative backed, so they'll say things like, no, we don't just track the FTSE 100, we offer the inverse performance. In other words, as the underlying rises, the ETF will fall, and vice versa. What's more, we might do it on a multiple basis, 2 times or 3 times. Now, as well as the barrier of do you understand what the thing is trying to achieve, even if you do, watch out for the way it actually behaves. There's a mathematical quirk that means these things simply don't do what it says on the tin, or not the way you might expect. Plus, they can be relatively expensive. You're paying for these fancy extra features like you would on a car, all right? And there are other ways of achieving this sort of exposure. There are other products out there, which I'm not going to cover in this video, which might be a cheaper way of doing the same thing. So quite a few caveats. Now, what do I mean by, even if you understand this thing, it may not do quite what you expect. Here's an example. So this thing offers twice the inverse performance of an index. So as, for example, the index rises, this thing falls and by twice the distance. Okay. How would that look? I'll show you the maths briefly in just a moment. The underlying index does that. The ETF, and I'll show you the numbers, does that. When you first glance at this slide, you might think, well, it's doing what you said, Tim. You know, the index goes up, this goes down. Okay, the index goes down, this goes up. But is it moving twice the inverse distance? And what's happened at the end here? Wait a minute. The index is down on its starting position, and so is the ETF. But wait a minute, isn't this supposed to do the opposite of the index? What's going on? This performance is all over the place. This isn't doing what I expect. Why not? Here's why not, okay? A couple of points just to finish off this video. First of all, let's take a situation where the index, it could be the FTSE 100 for argument's sake, goes up over 3 periods. It goes up 10%, then down 20%, then up 10%. So if you're just looking at percentages, it should be flat, but that's of course not the way the maths works. All right, so there's the index. Up 10% from 1,000 would be 1,100. Down 20% from there, repricing as we go along, would be 880. Up 10% based on that 880 would be 968. So the index actually hasn't moved by 0. Just be careful on that one. It's down 3.2%, which is what I tried to show back here, slightly below the 1,000 starting point. Now, let's look at the 2 times inverse ETF. What's going on here? Well, if each day you recalculate the change in the index, or each period, which is how they work, this is what happens. Twice a 10% change is 20, inverse minus 20. Twice minus 20, inverse is plus 40. And twice 10 positive is minus 20. So the percentages look all right. So in theory, it's flat, but in practice it won't be. All right, and that's because if the ETF starts at 1,000 as well, take it down 20%, you get 100. Take it up from there 40%, 1,120. Take it down from there 20%, 896. So it has dropped 10.4% against the index dropping 3.2. Hence, that bit at the end of my previous slide. And there's the problem. You have bought a product that gives you 2 times the opposite performance. That's the marketing of the underlying index. Yet the index is down 3.2%, and this thing, you know, is down 10.4%. In what sense is that giving you the opposite performance of the index? And is 2 times 3.2 10.4? Well, it doesn't take Einstein to tell you, no, it isn't. So the way these things work isn't always what people expect. And that's something to watch out for. It's a reason, frankly, not to really touch these things unless you really know what you're doing with them. That was fairly fast. All right, any questions? Please contact me at the usual email address.